David, welcome back to the program.
Ellis, great to be with you.
I know we just spoke last week, but I felt it was important that we catch up again in light of all the mayhem going out there with commodities.
Well, it's been quite a smash down. It's early April, so we're doing this interview, and basically commodities across the board got really hit hard today, the 4th of April. Gold's down, and we're still trading as we speak, but off about $75 in the last 2 days. Silver's off substantially as well, and even the platinum palladium markets are getting hit. And again, along with a lot of other commodities. So there's a lot of, I think, overdone situation with the QE3 postponement, which is basically what the Fed minutes said, which really was a release of their meeting of a month earlier. So it's really, anyone that pays attention to financial markets shouldn't be shocked by this news. And I look at that as sort of an excuse. I mean, markets move by buying and selling, and there's a lot of selling by professionals into the commodity sector today, and that's what's taking it down.
Did many of us just come in at the top and buy?
Well, the way markets work is that the excitement and the emotion that goes with tops generates a lot of interest and a lot of people buying the emotion. And to be honest, in my, almost 40 years of being an investor and trader in these markets, I see it again and again and again. I remember as silver was about a year ago, it really peaked around May 1st of last year, so it's been almost a year. When silver moved from like the $35 level on up to 48, every show I did, I was very consistent and said, if you have to buy some, but don't buy it all. And please be careful, because this is going parabolic. It's getting ahead of itself. As bullish as I am, I can see, someone could get hurt, especially if you're buying on leverage. And it was interesting, a lot of feedback that I got, and some from, considered professionals in the industry, were that, I was wrong, and, silver's going to go to 100, and you're going to ruin your reputation, and on and on. But I do my own work. I do have help. I have 2 analysts that work with me, and I do take input. But at the end of the day, it's my job and my reputation and the way I see it. And I call them as I see them, as you well know, Ellis. And I said, this is it. And I got out, I think, 2 or 3 days before the absolute top. It was in the $48 level. That's been the top for silver for a while. Gold did the same thing months later when it peaked out around the $1,900 level. And a lot of my associates and colleagues, et cetera, in this industry have been calling for, the next move up is imminent. And I've been saying for several months now, and on your show as well as others, that I felt we were in a long consolidation, and I really felt that it would probably take until probably the September timeframe before we come out of this trading range and start moving to the upside, meaning silver above 40 and gold above the $1,900 level.
Didn't we have at the end of February a staged suppression of sorts with regard to silver and gold? I know that sounds a bit conspiratorial, but it seems that every time gold and silver reach pinnacles, the Fed and the banks have to step in and wave their fingers back and forth, as it's not in their best interest for this to happen.
I lean more toward that side than not. I mean, money moves markets. That's a fact. So basis that fact, who's got the money and who's moving the markets is the next question. And, it's very apparent to me on this last smash down the silver market that took place on the 29th of February. I mean, that was pretty much given that somebody or somebodies wanted the silver market to sell off, because they sold off basically 110,000 contracts in one trading session, which represents about 2/3 of all the mining supply in silver on an annual basis. And I don't have the data today, but I'm sure today's sell-off is probably a massive amount of silver on paper to get it to move down at these levels. So, to say that it's normal market activity is not thinking very clearly, or someone doesn't understand how markets work, because somebody or somebody's, again, want it down. Now, exactly who, where, why, I don't know. We know when. It's taking place right now. So it's frustrating. But we also know that the fundamental fact for buying in the commodity sector hasn't changed. It's the only thing that's real out there, and it's still in a major bull market, although some damage has been done. And the more damage that's done, the longer it takes normally to consolidate and come back up and go through the old highs. And that's what I'm suggesting with what I've been talking about, is why I don't think that these new highs are imminent. I think it's going to take some more work and some more time before these markets start to move up again.
Could we see $20 silver this year?
I really doubt it. I base that on a couple things. One is the worst we've seen so far has been 26 and change, and it's been spike lows. In other words, just very few trades that took place at that level, and then it popped right back up. That's happened twice. So that tells me that someone that's in the know wants to buy silver on the cheap, and that's very cheap to their thinking, and so they came into the market rapidly. Didn't, again, take very many trades or so much buying to bring it right back up. Secondly, there's a lot of fundamentalists that understand what's going on in the global economy and understand what's real and what isn't real. And they're probably sitting on some cash, and they're probably ready to buy more silver and gold at the appropriate time, and that's based upon price. So I don't know what their price points are, but for silver, I'd say probably anything under 30, and for gold, probably anything under 1,600. You just have to wait and see if I'm correct or not. But I think there's plenty of money on the sidelines waiting for an opportunity. And again, people have different price points, but somewhere in that range or lower, there's probably going to be some sufficient buying in the market. So I don't see $20 silver, but I wouldn't rule it out. I mean, I'm smart enough to know that the market knows more than anyone. And so I couldn't say emphatically that it's impossible, but boy, it'd really take a lot of selling. If it's taking 2/3 of the silver market to move it down 2.5, and you're, still above 30, how much paper selling would it take to get it to 20? I mean, it'd be astronomical in my view.
Where's the reliability in the market right now, though? I mean, it's not hard for panic to ensue, even in a controlled way. I don't mean by institutions or individuals. I mean controlled selling, sustained, continued selling, where everyone attempts to get out before it gets any lower. And to continue that thought just a little bit further, those folks that are saying, I'll just wait a bit longer for gold and silver to come down before I get in, well, it's coming down, and why not continue to wait? Where's the reliability for the mom and pop investor? Where does it exist?
Yeah, now, great question. Markets are psychological, and until I figured it out, and luckily I figured that out fairly early in my investing career, I didn't factor that in as much as you need to. You're right. People say, well, as soon as silver gets to 31, I'll buy it. And then it gets down to 31, and then they have an excuse that, well, it's going to go lower. And these people never get in the market. I mean, there's some that will just watch it for entertainment purposes. And then, as it goes higher and eventually, starts making new highs, they wonder why they didn't do what they told themselves they'd do. But this is all psychology. And the possibility of the $20 silver is just that. I mean, the longer it stays, let's say it trades under 30 and starts to trade there for a fair amount of time, meaning a month or two or three. If that were to occur, then you would have more capitulation. In other words, very bullish people that had bought their silver at, say, 15 and anywhere along the line, but nonetheless, those people that had roughly a double in the market in not fairly short order, they start to question the silver market or the gold market. You could use gold as an example as well. And they say, you know what? Housing isn't looking that bad. I'm going to get out of this. The silver market's killing me. I could have taken a much bigger profit. I'll take this profit. And the more selling pressure, obviously, the more it could drive the price down. I really don't see that happening too much, especially in the metals, because it is the money of last resort. I think most people that are in the metals understand the metals. I'm talking about the physical market now, not the paper market. The physical market really does hold the strength in the market, even though we know the paper markets push the price around like they're doing today. We understand that. But from a long-term fundamental perspective, it is the physical underlying market that really has the strength. We do get these opportunities because of what happens in the paper markets to take advantage of them if you're willing to take action.
Shouldn't we be looking for places to place our money right now and always where it's going to really work for us? Perhaps like real estate, rental properties and the like, something paying residuals again and again?
Oh, absolutely. And, I have nothing against real estate. I'm not a real estate investor, but, I understand that market. It's a pretty easy one to understand. Basically, it's like a bond investment. You want a return on capital. So if you can buy a house for $100,000 and rent it for $1,000 a month, and that's net, you make $12,000 a year, you're making 12% on your investment. That's a great investment, whether it's, a house or a warehouse or a parking lot or a duplex or whatever. And the numbers are just there I can do in my head easily. So if that's the opportunity, then certainly I would say that's a great one. I personally think that the general real estate market is still overvalued, but there are instances. Again, I look at like on these mining companies. I look at them on an individual case-by-case basis. We had one we recommended about 4 months ago that pretty much has doubled. And I defy hardly anybody in this industry that can talk about a stock that they've recommended this year that's doubled, or in the last 6 months, or within the last year. And I'm sure there's some. We had one yesterday that's been on our list for quite some time that got bought out by a bigger company for a 30% premium. And not that we get everything right every time. I don't want to give that impression. What I'm trying to say is we do our homework here and we do our very best. And there still are opportunities even in this resource sector. But boy, it's been tough, and it looks like it's going to be tough for a while.
Whenever you do invest in anything like this, which is extremely speculative, you're taking a risk and you need to prepare for that risk. But you stated it well early on, David. We're in a bull market, a long-term bull market, and I stand by my investments.
That's right. I mean, the only thing that would change my mind is the long-term uptrend we're pierced on either gold or silver, but they could fall much, much more from where they are currently, and we'd still be in a major bull market. So I'm not predicting that. I'm not even suggesting that. I'm just giving you a fact that any long-term bull market has a part in it that wears people out. They start to give up, they capitulate, they say, you know what, I got in at the wrong time, or there's a better investment here, or whatever, and they move on. And it's been about a year since silver peaked. Hasn't been that long for gold, because gold peaked, I think it was around August last year. But still, people are very short-term, and once they get into an investment, they want to see it go up from that day onward, and that's not been the case for the metals or the mine equities for quite some time.
Do you think that when Bernanke just a few days ago said there may not be a QE3 this year, a quantitative easing, that this was some sort of intentional signal?
This is my opinion. I want to stress the word opinion. I think they do stuff like this to test the market. I really believe that. I think they throw stuff out there and see what gold does, and they do other things to see what gold does, and they kind of got this little, as I used the word before, psychology weaponry going, that they see what can happen. Of course, if it's also orchestrated with a bunch of their friends that might be selling into the market and enforce that psychology as well. I think probably the most common email that I get or correspondence has to do with how powerful the Fed is and that they can keep doing this forever, and don't I understand that, they have all the power and, that I'm wrong. In other words, that my premise from the beginning is that the physical market will usurp the paper market at some point, and they have the belief of the opposite, that these guys, whoever you want to call them, J.P. Morgan et al., can control the market forever. And they can't control it. First of all, if they could control it, silver still be at $5. And secondly, they can move it on a short-term basis. And you can understand that, and that's easy to prove. But nonetheless, it takes a lot more paper selling to move the market down than it does physical buying to move it up. And that's pretty much a very easy way to prove to yourself that the physical market is more powerful, because it's a fact that it takes a lot less physical buying to move this market up than it does fake or naked short selling to move it down. But it is discouraging, and I understand that. It's frustrating. I understand that. But nonetheless, fact is a fact. The physical markets actually have much more power than the paper markets. I got an interesting email from a gentleman who talked about paper money in France, and didn't I understand how this whole situation went, where the French government just kept bashing the metals as much as they could. And I thought, geez, he's making my point. He just sees it from a different perspective. The point is that the French Revolution went on, and that paper money died, and gold and silver were still working. That's the whole point. These paper money systems fail. The French Revolution came about because of that. So I didn't understand his point. To me, his argument was my argument. He just, again, saw it in a different perspective.
Well, the fundamentals haven't changed as far as supply and demand are concerned with regard to silver. So we should all just take a big breath and maybe a glass of water and even a walk.
Well said. Yes, I'm glad you wrapped it up that way, Ellis, because, sometimes I'm too close to these markets. I think a lot of investors are sometimes just too close. They look at it daily. Not that these days aren't frustrating, but I think, as you say, a deep breath, a walk, and look at the long term. Fundamentally, nothing's changed. And fundamentally, actually, there's no better reason to be in metals than there is today. And I think more and more people will wake up to that fact once this market starts to calm down.
David, always insightful. I appreciate our conversations, and I thank you for joining me today on the program.
My pleasure. Thank you, Ellis.
I've been speaking with the silver guru, David Morgan. David's website is silver-investor.com or themorganreport.com. You can listen to this segment again on the podcast page of our website, ellismartinreport.com.